It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast for another weekend. Yes, breaking down for you the Australian property market, and all of the crazy stuff continues around the world. What is going to happen next? Who knows? Got another very busy Saturday property show. That is coming up next, though, because understanding the Australian property market starts right here for your weekend. You know, we look at all of those major real estate markets for you in any one week. And if there is a market that you would like to hear more about, very simple, you can sound off about it. Tell us in voice form with our voice message service. The link is below in the show notes, or you can send us an email. Yes, the email address, myrealestatepodcast@gmail.com. Got another head-to-head too coming up this morning. This time we're going to have a look at a Sydney and Melbourne suburb, the suburbs of Balmain and South Yarra. That is coming up later. It is a Saturday morning, July the 25th. If you're celebrating a birthday today, happy birthday to you. Matt LeBlanc from Friends. He is turning 59. Also in world events, back on this day in 2000, Air France Concorde Flight 4590 crashed shortly after takeoff near Paris, leading to the eventual retirement of the Concorde fleet. A tragic aviation disaster. And in real estate news this week, interest rates are back in the spotlight, and the conversation has shifted almost overnight. What looked like a near certainty pause at the RBA's end, their next meeting is no longer guaranteeing that is going to be in pause mode. Financial markets, they are now factoring in the possibility of another rate rise even before key employment and inflation figures are released. And the RBA is next meeting on Tuesday, the 11th of August, so that isn't too far away. So what has changed? You know, what are the banks expecting, and what could another increase mean for homeowners and buyers? Well, let's take you to Brisbane this morning. We're going to catch up with Joshua Sale. He is the Group Manager of Research for Canstar. And welcome, Joshua, on to the Real Estate Saturday Morning Property Show. Yeah, as I say, just weeks ago, most economists believed that interest rates would remain on hold. So I guess if you're an investor, prepare yourself for every possibility at the moment.
Yeah, that's right. It's a fairly dynamic situation rather than a foregone conclusion that we're going to see a rate change. The labour market data did come out yesterday and it was stronger than many were expecting. We saw that flow through almost immediately into market expectations, and the probability of an August rate rise increasing again came in higher once more. So we're now up to a 37% chance based on the probability in the pricing market. So buckle in. The next big piece of the puzzle is next week's inflation data, and if underlying inflation remains stubbornly high, markets are likely to continue increasing the probability of another rate rise.
Yeah, and the next employment report and inflation figures, you know, it could become the deciding factors before, as we say, the RBA meets. How significant are these two economic indicators, and do you think could just one stronger than expected result be enough to trigger another interest rate increase? People are going to be holding on to your breath here.
The Reserve Bank are looking at so many variables and factors when they're making their rate decisions. It's important to moderate any one indicator, but the labour market, it was a bit hotter than most people were expecting. Time will tell if that also happens in the inflation data, but they'll be looking through the headline number and looking at core inflation. If that remains sticky, it's definitely possible that they look to get ahead of the inflation curve.
And homeowners, you know, another rate rise would mean another increase in monthly mortgage repayments. Then it becomes a trigger for buyer confidence and a dominoes effect across the market, which you can't rule anything out at the moment, as the Reserve Bank governor would say.
That's true. I think anyone who's been on this merry-go-round for the last 5 years knows that anything is possible when it comes to the Reserve Bank. 25 basis point increase to the cash rate, that's going to cost someone with $1 million mortgage another $1,800 a year. So when you compound that on the previous rate increases, it does start to really hit people's back pocket. That's why it's very important to make sure that you're getting a really good deal with your home loan, making sure that you've compared what you're paying to what else is available in the market. And even just going and negotiating with your bank, making sure that you are getting a sharp rate, because each one of these rate increases, $1,800 for $1 million mortgage, it's a lot of money.
Yes, households, they're budgeting like never before. With another rate hike, the tightening of the purse strings, it becomes next level. If we're not already at next level now, how do you cut back on the cutbacks? That's the question I'm sort of asking a lot of people with mortgages at the moment.
Yeah, it is difficult. You kind of have to look at your entire household budget, not just one thing in isolation. So if you look at, say, energy costs, they've been going up for a lot of people. If you're on the average energy plan, you could switch to a better plan and potentially save yourself $500 a year, which equates to about 3 to 4 months of that rate increase. I know it's not going to be completely game-changing, but all of those little savings add up.
And if you are worried about that and you're already starting to make some of those changes to the purse strings, let us know. You've got the email, myrealestatepodcast@gmail.com. We are talking with Joshua on our Saturday morning property show. Back with more in a moment.
From the emotion of property, the economic inflation, managing your expectations, lack of stock, price growth, construction appetite, days on the market. Stay informed with us and know your property.
And right now, as you know, we like to give plenty of these property tips, and somebody we caught up with not that long ago, Luke Dawson from Simple Property Group in southwestern suburbs in Perth there. And what have you got for us this morning?
Yeah, look, Craig, I think a really topical one at the moment is helping buyers out with some tips on being the most competitive they can be with their offer. Things like being organised with pre-approval where possible is a great start. Definitely communicating with the agent as far as what the vendor is chasing. Things like flexible settlement terms can be really helpful in making your offer stand out from other offers. And just being as organised as possible, seeing the property and being ready to act.
You're listening to the Saturday Property Market Update.
Now, we've got a really interesting head-to-head here, Sydney versus Melbourne. I've chosen Balmain in Sydney and South Yarra in Melbourne because they're both premium inner-city lifestyle suburbs. So let's have a look at the numbers and how they shake out. In Balmain in Sydney, the median house price is $2.8 million. The median unit price in Balmain, just over $1.4 million. House growth in Balmain over the last 12 months is 12.6%, which is great. Unit growth is 2%, and the house rental yield 2.5%. Unit rental yield in Balmain 3.5%. South Yarra, currently the median house price $1.9 million and change. Median unit price in South Yarra $540K. That might surprise a few. The house growth in the last 12 months in South Yarra has gone backwards, minus 9.6%. And the unit growth has also gone back in the last 12 months, minus 5.6%. House rental yields, South Yarra 2.8% and the unit rental yield 5.6%. So Balmain, it does continue to demonstrate resilience. As I say, those house prices have climbed to more than 12% over the last year, reflecting continued demand for premium lifestyle locations close to the CBD. And South Yarra, it does tell a different story. While it remains one of Melbourne's premier suburbs, values have definitely softened over the last 12 months. It is a Real Estate Saturday. Joshua is here with us, having a look at the RBA and what is maybe likely to happen when they next meet. And here's a question for you this morning. Why do you think we're seeing already banks reducing variable loans at the moment?
Yeah, market expectations influence their funding costs, and funding costs are one of the factors banks consider when pricing mortgages. Banks are constantly balancing two competing forces though. On one hand, higher funding costs put pressure on margins. On the other, competition for quality borrowers remains strong. In a softer housing market, banks still want to grow their mortgage books, so pricing isn't determined by funding costs alone. So it's very important to making sure you're with the correct lender that's really looking for that good quality borrower, because that's where the best prices are going to be.
It has never been more important for you to shop around for the best rate. As we say, if there is another cash rate rise coming, it's something that is absolutely mandatory. It's a great talking point at the moment. Everybody's got an opinion. Oh, should I go variable? Should I go fixed? I suggested over a year ago, when things were looking in a different spot where, we were getting these cuts in the interest rate, I was saying, well, now's probably a good time to fix it. Everybody was saying, no, let's go with the variable because now's the improving position, and then everything has changed. What do you think people should be doing?
The best benefit you get out of a fixed rate mortgage is certainty. You're effectively trying to price up the economic conditions against the bank's chief economist. They're looking ahead, so when they're looking at setting their fixed rate mortgages, they're pricing that based on their expectations of where interest rates are heading over the next few years rather than today's cash rate. So when markets reassess the outlook for future rates, banks often will adjust those fixed rate mortgages accordingly, whereas variable rates, they tend to be much more closely linked to the actual bank rate decision. So it really depends. I think if you want certainty, fixed rate, sure. But remember, they've already priced in where they think that the interest rates are going.
What you're saying is the economists are looking further out, trying to make calculations on what the fixed rates are going to be. At the moment, in this volatile market, I suggest to you that nobody can actually forecast what is going to happen next. Not even the brightest of brightest economists know what Trump is going to be doing from 1 minute to the next. If you want safety, then yes, I would get in and fix your mortgage rate. But hey, that is a conversation for another day. Good on you, Joshua. Thanks for coming on to the Real Estate Breakfast this morning. It's certainly something that we're going to be watching with a lot of interest with the RBA. That next meeting, as I mentioned, coming up on Tuesday, the 11th of August. Enjoy your weekend. Have a great week.
Thanks, Craig. Appreciate the time.
Explore new property destinations where you could live with exclusive interviews covering real estate news and market insights.
A lot of them have been taught by their parents that bricks and mortar are a very safe way to get ahead and to build wealth, and at least you've always got something there. It's not like a financial market where there can be pretty dire changes. But I think that people probably need to become a little bit more sophisticated in the way that they look at allocating capital if they're going to move into commercial property.
So one of the things that you can do to protect yourself from that sharp energy coming at you is to make sure at the entrance you put something in red. Red is considered fire element.
What the government's trying to do is to improve transparency and address underquoting. The unfortunate way in which they're looking to try and solve the problem is going to force things into areas that are going to be less transparent for buyers. And it's really important to note, Craig, this is not a requirement of agents, even though they're trying to put the responsibility of agents onto the transaction.
Yeah, that's absolutely true. I have spoken with some developers and architectural groups who are using the Middle East and even Florida, interestingly, as examples for what they could bring down under. And one particular thing that we haven't seen a lot of in Australia and may well do that other countries are doing is branded residences.
We connect you to the best real estate information across Australia. The Real Estate Podcast.